Good morning. Happy Thursday, everyone. So I am feeling so much better. Oh my goodness. So I'm finally feeling back to myself again. So we are actually a week out from Thanksgiving. So I don't know what y'all's travel plans are, but the fam and I, we're going to be hopping in the airplane next Tuesday, heading over to Dallas. So for all of my Dallas folks, I got a few people that I'm going to be hitting up when I'm in town. So if you're in the Dallas area, you want to grab some lunch, a cup of coffee, whatever, hey, holler at me, okay? So today I actually had another topic that I wanted to get into, but because of this overwhelming question ever since the Arizona event, all right, a little high level. Brent and I were out in Phoenix, Arizona, Glendale to be exact, and it was the annual assisted living conference. Shout out the RAL Academy. If you are interested in getting into residential assisted living as a business, as an investor, go and really research Isabel Garino, her company, RAL Academy. They are a wealth of knowledge. I got a lot of folks who are clients of mine and then branch off and use their policies for the RAL space. Because a question actually somebody posted in the Facebook groups is, hey, how do I use my policy to create and build an asset that creates cash flow? So that's just one avenue that y'all can take and use in your policies to create some cash flow that's coming in with your money. All right. And then just a little shout out too. Okay. I'm going to do a little teaser. We've been talking about it a little bit, but coming up in Tampa, this is exactly what we're going to be talking about is how can I go and use my policies or your self-directed IRAs, wherever you're storing your money at. Me personally, I keep my money in my policies. I'm trying to funnel as much cash flow through there as possible, get that uninterrupted compounding. But how can I go take this money and then go and place it towards an investment that creates me that cash flow? So I got my people coming out, my multifamily, RAL, Isabel was actually at our event last year, and oil and gas, private lending, stock options trading. You might be thinking to yourself, well, Hannah, I don't really got a whole lot of money. How can I even get started within these spaces? Hey, let's talk about creative financing, subject to seller financing. So there's so many different avenues that it's just not taught in mainstream financial literacy, right? And so that's my goal is that how can I help our community thrive and build up their empire? Because you're going to get to that point where you're filling up your own cup that you just start overflowing into other people's cups, right? So it's been a lot of fun. So come and join us in Tampa. It's at the end of February. February 27th is the VIP day, and then 28th and March 1st, classroom's going to be in session. So come and join us, moneygamelive.com. So today's topic, I want to tackle the two biggest objections I hear every single week, and specifically when we're in Arizona, because it is it's an asset class that we're helping older individuals, right, with that assisted living care. And so two of the biggest things that I heard from this past week is one, I'm too old to do this. I'm going to debunk that right now and showing y'all exactly policy illustrations. So number one, I'm too old to do this. And then number two, the premiums are just going to be way too expensive at my age. So let's look at the truth behind these statements, because most of the time, it's not about the age or the cost. It's about understanding how money really works. Okay. Now, a little update over here. Oh, and we got some comments coming in. Oh, good morning. Good morning. Mr. Dexter, hello. Good to see you. So a little life update. Y'all, I have spent this whole week having to go back and dispute some charges with Delta. And then Paramount Plus. Okay, so this is why it's so important, y'all. If you aren't already doing this, you need to go into your cash flow and your credit card statements and look at those things every single month, because it's like, hey, I didn't sign up for Paramount Plus. Why is Paramount Plus charging me right now? So I have to go through all of that. And then get this, back in July, I had a flight from Daytona Beach up to LaGuardia in New York City. Y'all, so first of all, because of weather, Delta was delayed, right? So I got into Atlanta, so Daytona Beach to Atlanta, I got there, but then I missed the connection from Atlanta to New York. And so essentially Delta actually sent us the QR code. They put us up in a hotel, which was amazing. And then when I walk in and I'm checking into the hotel, it's like 11 o'clock at night. And, they ask for the credit card for any incidentals. So I give them the credit card. Well, then the hotel charges me for that night stay. So now I'm like, y'all, Delta paid for this. Look at my confirmation number right here. Look at this QR code. So now I'm fighting with them too. It's just so annoying. But it's like, this is Parkinson's law, right? Even though it's only $202, okay, could I live without it? Yeah, but that's my money, right? I'm not just going to let that thing sit there. So you always have to just be in this mentality of, hey, taking control of your own financial life, because nobody's going to have that responsibility and ownership besides you. So that's what I've been kind of spending this week doing, is working with American Express and Delta. It's just been annoying. Been working on it since July, actually. So anyways, that's just a little life update. Now let's get into our content here. So with these two biggest misconceptions when it comes to infinite banking, I'm too old to do this and my premiums are just way too expensive. Here's the mindset shift that we have to have. IBC, it's not about age, right? Because I think a lot of people like to look at the infinite banking concept that it's just about the product. It's just about the whole life policy. No, it's not about the product. It's about the process of how we're using the policy. So what that means, it's talking about the control, the leverage, and the legacy that you're able to create and build using this policy and this system. And you're never too old to take control of your money, because infinite banking isn't a 30-year retirement play. It's a lifetime liquidity and legacy control. And so a lot of the times, older clients who are coming to me, they're thinking that, hey, I can't do this because I'm too old. The premium is just going to be way too expensive. But you are kind of in an advantage point at the same token compared to some of my folks who are younger in age, because you've been working for a lot longer. You have a higher cash flow. You can fund larger premiums. And that's kind of fun, because more premium I put into my policy, more capitalization, and just a bigger compounding bucket that I can compound on and then use, right? And in my opinion too, why I even have a special place in my heart for my older individuals is y'all have this deeper why. You're looking for asset protection, you're looking for tax strategies, you're looking for that legacy, right? And so y'all need to understand that this is just my opinion. I just believe that when we're implementing this concept, you want to start with the matriarch and the patriarch of the family first. I'm not saying that you can go in and insure everybody within the family, but think about it. One of the biggest bonuses is that it's a life insurance policy. There's a death benefit on that policy. And so when the time happens that we graduate, pass away, there's going to be this lump sum of death benefit money that's going to get paid out to the beneficiaries, whoever you listed as a beneficiary on your policy. Now, side little nugget, FYI, owner and beneficiary of your policy can always be changed. Okay, so sometimes people will say, hey, I got to wait to do this because I want to establish my trust first. No, you don't got to establish the trust first. You just got to get started, right? Because it's all about the time value of your money. The sooner that you start and get the dollars into an environment where it is on now an uninterrupted compounding clock, that policy is always going to be better and more efficient than the newer policies that you start, because it's just the time of that compounding that you've had in that policy, right? So I just believe that we need to start at the matriarch and patriarch and then go to the downline, because that death benefit money is what leaves that generational wealth to our family and our heirs, right? And sometimes too, people will think, I'm thinking about this conversation I just had yesterday where this gentleman wanted to put a policy on his 12-year-old son. Well, and I asked him, well, why do you want to start on your 12-year-old son? Well, because it's going to be cheaper to do that. Well, think about it. No, it's not going to be cheaper. I'm going to debunk that here in 1 second. But let's say that you have debt still within your life. You may have a house mortgage. You may have debt on a business or a personal line of credit, credit cards. It don't matter what it is. But if that policy is not on you, now you're just passing down that debt to your next generation, right? So that death benefit is there so that we're not burdening our family when we do pass with this debt that's just not paid off yet. So then they can use that death benefit money and pay off some of these debts to get our assets at that $0 line of no more that we have to pay on it anymore, right? So don't neglect the death benefit when you're looking at this. Now, yeah, Dexter, just got started. Earn as you learn. All right, I'm going to pull up here my illustrations that I want to share with y'all. Okay, so these are definitely for my number nerds people. Okay, this episode is for you. But what I wanted to do is I kind of wanted just to compare an apples scenario from a 26-year-old to a 66-year-old. All right, there's a 40-year gap between them. And I just used my name up there, Hannah Kesler. And this one that we're looking at, this is our 26-year-old illustration. Now, before we get into the numbers, I want to show y'all why this is an apples scenario. So this is just from an illustration from a company called Lafayette Life. There's 6 different insurance companies that I personally do business with. So this is just one of the 6. I just use them because no rhyme or reason, I just use them. So here on this additional information page directly from the illustration, it breaks down your premium information and how those premiums are being applied. So on this policy, what I did is I took a $24,000 a year premium. So $24,000 a year, $2,000 a month. Now, remember, you get to decide how much you want to deposit into your policy, right? You get to decide the premium. You get to decide the frequency, monthly, quarterly, twice a year, or annual premiums. You can always jump back and forth between those different modes of premium, right? If right now it makes more sense to do annual, but then next year you want to switch it to quarterly or monthly, you can do that. You got the full freedom to change that. But what I did is I broke down this $24,000 of premium and I allocated the same amount of monies to the base premium, to our term rider, and the paid up additions rider. Okay. Now, if you're unfamiliar with those terms, I do have a resource video for you. So put it in the comments if you want that resource video of explaining what is base premium, what is the paid up additions rider, and the importance of them. But here, I broke this down in a 25-75 split policy design. So what I mean by that is 25% of the premium is going to the base and 75% is going towards our paid up additions. Now, I will say this. because I'm not going to spend a whole lot of time on this today, but policy designs, there's different ways to design these policies. Personally, being 26 years old, I wouldn't design my policy like this just to have a 25% base premium. Why? Because that base premium is what creates that longevity growth in the policy, that strong foundation. And it also allows me to keep paying in as much premium that I possibly can inside of my policy. Because what is one of Nelson Nash's rules? Capitalize, capitalize, and do not be afraid to capitalize your own banking system. I say this in another way. Have you ever made too many deposits into your checking or savings account? Probably not. So you got to have that same mentality when you're looking at the policy that, hey, this is kind of nothing more than just my glorified savings vehicle. And have I ever made too many deposits into my savings or checking account? No. But I'm doing this again just to compare the apples to apples design. Now, given on my 66-year-old, I'll come over here, obviously, I would design the policy this way, 25-75 split, because I understand where you're at in life right now. You don't have all of these years to capitalize and build up that cash value within the policy, so you have more of an immediate use for the policy. So here's kind of like a good way to look at it. The base premium, if you kind of think about the policy, almost like you're building a house, okay? And the foundation of that house, that's your base premium. And then your paid up addition riders are the structure that's on top of that house. So you don't want to build a house on a wobbly, unstable foundation, right? So that's why I'm personally not a fan of 1090 policies. And if somebody's telling you to do a 1090 policy and that's all you should be doing, you should need to research and think for yourself and dig a little bit deeper. Reach out to me and I got some resources for you where we get deeper into the numbers. But on my 66-year-old, I would design the policy this way because I understand where that individual is at in their life right now. For the 26-year-old, their policy is going to be built more as a 40-60 split, 40% to the base, 60% to the paid up additions. Heck, my first ever policy at 18, my dad actually designed it 60 base, 40 paid up additions. And when I saw that, and I literally saw it after I paid my premium, and I was like, Dad, why in the heck did you design my policy this way? I want my money. I need my money right now. And he's like, no, you don't, Hannah. No, you don't. Shut up. Go away. And now that I'm older and I understand this stuff more and more, I'm like, Dad, thank you for shutting down my ignorance, and thank you for designing the policy this way for me. So again, there's different pros and cons to how you design the policy, but here for this example, I'm doing the apples to apples comparison. So at my age of 26, you can see that there's $5,995 that's going towards my base premium. All right, if I switch it over to my age 66, you can see that there's $5,999 going in. All right, close enough for government work, right? I got it as close to apples as I could. So that's what's going into my base premium on my 66-year-old. Here's what's going into the base premium on the 26-year-old. Then what I did is we had to add on a term rider to this policy. So you can see the term cost here. On the 26-year-old, it's costed me $1,008.70. On my 66-year-old, it's cost me $1,009.50. Like I said, close enough for government work, right? So what's the purpose of the term rider? Just real quick. The term rider is here on the policy because we don't want to cause this policy to hit what's called the modified endowment contract status, or sometimes you hear us refer to it as the MEC, modified endowment contract. So what the term rider does is it manipulates that death benefit or the MEC limit to push it high enough so that we can funnel in all of this extra cash inside of the policy, and now we're not causing any tax consequences in it, right? Because that's the thing about the MEC limit is that if you totally overstuff your policy and go over that imaginary MEC line, then the government now is going to look at your policy like an investment rather than an insurance contract. And then now you're going to be subject to tax consequences, right? And we don't want that. I want to keep all the tax-free growth and benefits that happen with inside of the policy. So on a policy design like this, on a 2575, you're going to have to add on that term rider there. On policy designs like a 4060, no, you don't got to add on term riders. And if I don't have to add on a term rider, I don't want to add it on, because personally, this is just my opinion, I would rather have this $1,000 a year going towards the base premium or the paid up additions or an asset class that actually creates me some cash value or cash flow. I'd rather that money be going towards that rather than just renting this death benefit and hopefully me never seeing it, because the only time that I would win within this term rider death benefit is if I actually pass away during that time, right? And that would kind of suck. So that's the only purpose that this term rider serves, and we need it on the policy just to support our MEC limits, right? And you can even come down here, right here, it says the initial 7-pay premium. This policy as illustrated is not a modified endowment contract. So another piece of advice too, you don't want your policies to become a MEC. It's not the end of the world if it does become a MEC, but you just don't want it to. So then you can see we do have an apples to apples comparison on my 66-year-old. We have 16,990 going towards the paid up additions. And then on my 26-year-old, we have the same amount of money, 16,990. Okay, so you can see that I really built this out to be apples to apples. Now, a little side note before I get up into the illustration pages. If you ever needed to, look right over here where it says minimum required annual premium. Your paid up addition premium, this is not a mandatory premium that we have to pay inside of that policy. So just keep in mind, if you ever come into a downtime or cash flow is just not looking good right now and you need to buy yourself some extra time, you can always go inside of your policy and reduce down those premiums. But what is a required premium that we have to pay is our base premium and that term rider. Now, given we don't have to pay the term rider, but if you cut this thing off too early in the policy year, in the policy's life, you could be subject to hitting those MEC limits. So you can always see here that, hey, I can always reduce down this premium if I ever needed to. Now, let me kind of scroll back up, and I'm going to go to year 1 of this policy illustration on my 26-year-old. And let me hop over here, and I'm going to do the same thing on my 66-year-old right here. And real quick before I get into it, let me check my comments. Good morning, Mr. Connor. So he says, in some cases, can't you convert the term rider to whole life, or would that cause a MEC? Yes, you could, but it could also cause a MEC. Okay, so if you convert the term rider into the permanent whole life too early on, it could cause that MEC status. So again, if y'all are clients of the Money Multiplier, you know that you can always reach out to your money mentor or your implementation agent, and they can help you do this. I'm going to shout out Miss Terry Dexter. Terry. We're working on that right now. She's got her portfolio of 8 policies. And so on one of them, there's the term rider still attached onto it. And so we're looking at, hey, can we convert this? Can we just drop it off? Do we have to pay this premium right now? So we're kind of looking at that. So thank you, Connor, for your comment. Okay, getting into the illustration again. What I'm going to do in comparing these is I'm only going to look at the guaranteed side of the policy. You can look at the non-guaranteed side too, right? Non-guaranteed, the only difference is that annual dividend column. Okay, so Only difference between guaranteed and non-guaranteed is just that dividend, which, speaking of, hey y'all, actually One America just posted out a statement. It was their record-breaking year this year. And I saw this last week, and I'm pretty sure this is the number. I could be just one number off, but they declared a $42.5 million payout in dividends to all of their policyholders. So kind of think about that, where you're storing your money at. Everybody else is kind of freaking out within the economy, what the markets are doing, the political environment that we're kind of in right now. But these insurance companies, these mutually owned insurance companies that have been around since the late 1800s, early 1900s, they're having record-breaking years on their dividend payouts to their policyholders. Seems kind of interesting, don't you think? All right, just something to look at. So the only difference between the ages is going to be the death benefit. Okay, so let's look right here on my age 66 person. When I put in my $24,000 of premium, I have a cash value of $16,306. My death benefit is $243. Let's switch over to my age 26. $24,000 of premium goes in. I have the same cash value, again, close enough for government work. And then my death benefit is 1.5 million, right? That just makes sense because I'm younger. That dollar is going to be able to buy me more in death benefit compared to the 66-year-old. But that's not why we're meeting here. We're not meeting about the death benefit. And as Nelson Nash would always say, as long as I can solve your need for financing cash while you're living, you will have plenty and enough death benefit to leave to your family and heirs. So that's what we're solving. And get this. Okay, sorry, ADD is going off. I'm so excited to go to Texas. I haven't told my papa yet. Papa's my grandpa on my mom's side. And I'm going to sit down and have a conversation with him because I'm going to ask him the question, hey, Papa, where you're at in life right now, what's more important to you? Is it cash or is it death benefit? And I'm going to see what his answer is. I'm not going to get into all the details right now, but I know what his answer is going to be just because of the situation he's in. And I want to ask him permission if it's okay if I share, some of that vulnerable information with y'all. But think about it. When you get into those later stages of your life, what's going to be more important to you? Is it going to be cash or is it going to be the death benefit that you leave to your family once you're no longer here? And people may have different answers, and that's okay. This is kind of the freedom of the infinite banking concept. You have your own goals, your own ideas and things that you want to do. But let's be real, 9 times out of 10, what's more important is going to be the cash value here. So let's just skip forward, right? I'm still on my age 26-year-old. Year 5, I put in the $24,000 of premium. My net cash is $92,271. Let's switch over to the 66-year-old. In year 5, you put in $24,000 of premium. Your cash value is $94,341. Oh, would you look at that? At the age 66-year-old, you have more cash than the age 26-year-old. So do you see what I'm saying is that age only affects the death benefit. It does not affect the cash in your cash accumulation of what's happening inside of this policy. And I just wanted to do this episode. Honestly, I'm appealing more to self-interest because when this question gets asked to me, I'm going to send them this recording. I'm going to send you this podcast episode. I'm going to send you this YouTube episode, and I'm going to prove to you that just because you're older, it does not affect your cash value of what's happening inside of that policy. Let's look at year 10. Year 10. Oh, actually, let's talk about this before we get there. You can see as well at year 7 of the policy, that's our last year of paying $24,000 of premium. I did the same thing over here on the age 26-year-old just because I, again, just wanted to show that apples to apples comparison. But if this was me, I am going to pay my paid up edition premium for as long as I can and for as much as I can. Okay. Because again, to go back, Capitalize, capitalize. Don't be afraid to capitalize your banking system. But at that point, if you really wanted to, take that additional $16,000 that you were paying into the paid up additions, start a branch office of your bank, start policy number 2 or number 3 or number 4. It doesn't matter, but you can take some of that money and now just expand out and start this additional policy. Now, y'all might be thinking to yourself, well, Hannah, why would I do that? Why can't I just go in here and increase the premiums that I'm paying into this policy? Well, there's kind of 2 reasons to that. Number 1, if we keep continuing to pay this paid up addition premium for longer and longer, you are going to at some point hit that MEC limit. So there is going to come a point where we're forced to drop off those paid up addition premiums, because if we keep paying into it, then we're going to hit those MEC limits. So just keep that in the back of your mind, that that is something that could happen if you keep overfunding into the PUA premium. So I just dropped it off here at year 7, just so that y'all can see the apples to apples. So what's dropping off here is the paid up addition premium, and then also that 7-year term rider. Okay, so that's why you see from year 7 to year 8, the premium is dropping here. Now notice, on the death benefit specifically, you can see that it just remains level throughout the course of the policy's life here. And the reason that it remains level is just because the guaranteed side is showing us no dividends are being paid into the policy. So this would be accurate if no more dividends are getting paid. But if you look over here at your non-guaranteed side, you can see that that death benefit keeps increasing year after year. And it's just because of how that dividend is being paid back inside the policy. So in my opinion, when you're designing a whole life policy for the infinite banking concept, use that dividend to go back inside and purchase you more paid up addition premium. Because when you purchase more paid up addition premium, number 1, it's going to show up as cash value in your policy. So that's how the dividend is going to show up. And then number 2, it does buy you that extra death benefit year after year. So every year when the cash value keeps growing, the death benefit keeps growing right alongside with it. So at year 10, let's just take a comparison look. I put my $6,000 of premium in. My net cash value at this point is $145. At my age 66-year-old, at year 10, they're going to be 76. You put in $6,000 of premium, my cash value is $147. I'm still ahead, even though I'm older right now, coming from my 66-year-old. So I don't know. I just really want y'all to grasp this, because again, the death benefit is very important, and it really just comes back to, we're doing this to have the freedom, the liquidity, the control, the protection against outside forces from our money. And that's the purpose of why we're implementing these policies. Now, given death benefit is important, but most people are looking for that cash value and using the cash value for the banking business and banking function within our life. So let me kind of switch back over here. I'm going to remove this from the screen. Connor saying, good morning, good morning. More money going towards PUAs. Yes, sir. Shane is saying, I looked at my first policy as starting my secured life savings. Yes, sir. I could learn how to use it later. I currently earn more in my policy on my 3rd year than I put in for my premium. It's a money tree. Hey, you know what's funny? My mama would always say this because, you know, I grew up in a household where my dad, he wouldn't even allow us to order soda when we go to dinners. Okay, so like we would have a tradition every Friday night after we got done from school. We loved Buffalo Wild Wings, okay? Spicy garlic. Give me my celery with ranch, okay? That's what I love. And mom and dad would want to go and get themselves a beer, but he says, nope, you kids, you guys are drinking water. We're not going to spend $2.50 here at Buffalo Wild Wings. We got 20-cent cans at home. So you guys can't have any of your soda here. You can go drink the soda at home. So my mama, she would always say, like, when us kids would come up and ask her for things, she says, what do you think? You think I got a money tree growing in my backyard? And now, Shane, since you said that comment, I said, yeah, you do have a money tree growing in your backyard. You guys got over 28 policies. So give me some money. That's good, Shane. Shane saying, hey, thank you for clarifying. Dividends are used to purchase more PUA and becomes more death benefit, more cash value. That is awesome. No, yes, sir. Yes, sir. Hey, and Shane is a great resource too. Shane, a lot of y'all met Shane. He came out and did a case study for us in Denver at the annual Money Multiplier Mastermind event. And he brought out his whole family. So Shane, hope the family is all doing well. So I wanted to debunk that. Here for this, let's also talk about, okay, number one, I'm too old to do this. Okay, so hopefully I helped you debunk that. Oh, let's talk about this. Two life stories. Number one, when I first got into this business and started teaching it, I would normally say that the insurance companies would stop handing out whole life policies around the age of 75. And then I had a gentleman, his name is Wayne. Wayne came to me at the age of 78 or 79. I think it was 78. And he wanted to start this stuff. And I said, okay, well, let's give it a shot, right? I'm always down to give things a shot. So he went through the underwriting process and he got approved at the best health rating that you can get on a policy. He actually gets better health ratings than I currently get on my policies. I know I'm trying to lose a little bit of weight here, but he did. And so I said, okay, well, now I'm going to change my terminology and I'm going to start saying that they stop handing out whole life policies around the age of 80. And 80 really is kind of like that top line. Again, I'm always open and down to, explore further, but, so that happened with Wayne. And then Sandra Fry, y'all, if you guys tune into the Money Multiplier podcast, y'all just met Sandra and Mike Fry on this past week's episode, which is a great episode. Go check that out. Every Tuesday, a new episode launches. But Sandra had a client where they got approved on their 80th birthday. On their 80th birthday, they got approved for their policy. So age, it does not determine your need for the financing cash during your lifetime. So don't just think that, hey, this disqualifies me from banking. No, it just changes the strategy. Your policy is going to be built with more paid up additions in a smaller base because of where you're at in your life right now. And just the strategy of how you're using that policy is just going to be different compared to me, who's 26 years old, right? And let's get into number two, that the premiums are too expensive. We got to get into the mindset shift, right? That premiums aren't a cost, okay? Yes, a premium is a payment into your policy, but most of the time when we think about premiums, we're thinking about it as a debt, an expense, a cost to me. But you need to start thinking about your premiums like they are deposits into your private personal bank. Because when that money goes into the policy, you have cash value made available to you immediately. And what's my definition of immediately? Within 30 days. And then you can take out that money, use it for whatever you want. And you control the contract. You, the policy owner, you hold 100% control and ownership of that contract. So is that premium? Is it treated more as a payment because of this policy design, or is it treated more as a deposit? I think it's a deposit. And I just like to use the word premium deposit just because it gets our minds into the perspective of thinking about this as our own banking system. So you're not spending money by paying that premium. I put a little asterisk next to there. You're not spending money. Yes, you're buying a policy. You are paying for this death benefit. But really what you're doing because of the policy design is you're redirecting that cash flow and you're redirecting where that money is being stored at. And in my opinion, every dollar has a job and a duty, and I need to go put my little green men to work. So when I go and put my green men into the policy, this premium builds my capital foundation of where I'm warehousing that money at. Matter of fact, if you've never read one of Nelson's books, Building Your Warehouse of Wealth, that is a great book, because behind me, actually it is, it's right up there. I got it up there. I'm not going to get up and get it right now, but this is just a few of my books. All my other books are on my bookshelf in my office. But Building Your Own Warehouse of Wealth is a great resource for y'all if it's been a while. Hey, reminder too, if it's been a while and you haven't read Becoming Your Own Banker, I personally reread that thing 1 to 2 times every single year. I would encourage you, go back to the foundation, Becoming Your Own Banker, reread that one too. But every dollar must have a job. And when I'm redirecting that dollar into the policy, I'm giving it the duty to work harder for me. Because now, number one, I'm earning more interest in my policy rather than if I were to just keep it held down at the local bank. So I'm earning more interest in there. And then on top of that, when I leverage or take out that policy loan, I'm not interrupting the compounding interest of what's happening in the policy. And on top of that, you think my policy grows tax-free or taxable growth? It's tax-free growth. Money sitting inside of our checking and savings accounts, that's taxable growth. And we got to go and pay the pennies on the taxes that we owe on it, right? So with the premiums, and if you're thinking they're just going to be too expensive at my age, your policy and that design of it is all catered around to you specifically and your own cash flow and your budgeting. You don't have to start so huge, right? You get to decide how much you want to deposit into your policy. So when I was having these conversations with these RAL people, a lot of them are 55 plus, having their own homes or just starting to open up a home, the investment property to run the business out of. And I don't think I clarified, RAL just stands for residential assisted living, which is, sorry, now my ADD is going off again, but it is a great asset class to get into, because even just with Nanny and Papa, touring some of these homes, oh my God, I walk in there and I'm like, I wouldn't even live here. I don't expect you to live here because I wouldn't even live here. So I have a huge fascination with it, because at that time when let's say mom and dad need to go somewhere, I want them to be comfortable and I want them to feel at home and not just feel like they're living in this gray cinder block box, right? I mean, some of these homes are just freaking gnarly, man. I wouldn't even live in them. So I forgot how I got on that topic now. So to get back to my point that the premiums are too expensive, you get to decide how much you want to deposit into your policy. Okay. So my biggest advice, this is what I was thinking about. When this gentleman was talking to me, I said, no, I said, no, you got to get all of that traditional whole life mindset out of your head. This is not for the death benefit purpose. Yes, death benefit's going to be there, but we're building it to create our own banking system and the foundation of where we're leaving our money at. So you got to get all of that traditional knowledge outside of your head. And this is something that's totally different in the angle of that we're attacking it. So you're already going to be paying the premiums. And you are already paying your policy premiums, but what you're just doing now is you're paying it out to everybody else. You're paying it to the banks, you're paying it to the credit card people, to the car loan people, you're paying it to the mortgages, you're paying it to the student loans and housing people. And it's just time that you need to start paying yourself instead. And I would even go deeper, you need to start paying yourself first as well. And the money that you pay yourself first before you go and pay any of your other bills, that should be the premiums that start to go inside of the policy, my opinion. So it's not about your age or the affordability. It's really about the priority and the perspective here. And the question isn't, hey, can I afford to do this? I would really frame that mindset of, can I afford not to do this? Because the infinite banking concept is about reclaiming the control from banks, from Wall Street. And no, this is not about rates of return, right? Y'all are going to go and invest in the things that you like, know, and understand. I say that all the time. I'm never going to tell you how to go make your money, how to invest the money. What I'm talking about is the money that I'm already spending on my purchases, my services that I'm buying. How can I recapture the money that I'm already spending? And how can I protect my vault that I've took years to build up? So too old and too expensive are really just different sayings of, I don't fully understand this yet. Can we agree on that? So if these have been some of the objections that have been on your mind, it's okay. And let's walk through it together, because the numbers and the design, it's going to be catered to specifically what you are doing in your own personal life. And honestly, there's no secret sauce that I put on my policies that I don't put on y'all's policies. My policies are built 40-60, 40 base, 60 paid up additions, no term on them. Some of them 60 base, 40 PUA. Some of them are even 50-50 policy designs. Personally, just because of my age, I've never gone higher than having, or I should say lower. I've never gone lower in that base premium than that 40% of my premium that's being allocated towards it. So before I close out here, let me look at some of these comments. Good morning, Miss Tess. Always worth a try. Yes, sir. Or yes, ma'am. Sorry, Miss Tess. Miss Lisa, good morning. I'm seeing all my girly pops on here. Hey. She says she's paying herself first. Premium is a deposit. Dexter saying PUA sounds like it has more benefits, ? I stuff mine as much as possible these days. Yes, that's exactly what you should be doing. Any extra monies that you have lying around, we can't change the base premium, right? Your base premium is fixed. And as I'm sitting here talking about this, I need to do an episode on IUL versus whole life and like the cost of insurance. I want to make a note for myself. But Dexter's saying, hey, if I have extra money lying around, I'm just stuffing this money as extra PUA premium into my policy. Yes, which is good. You should be doing that because your base premium is fixed. It cannot increase. It cannot decrease. So the only way to get extra money inside of these policies is if you put in more an extra paid up addition premium. So I encourage y'all to do so. And here's just a little side nugget, if this is helpful. When I go and I pay my premium, because I have a premium coming due in January, February, and then March. I got 3 annual premiums coming up and coming due. Hey, and how do I prep for my annual premiums? I will actually pay back my policy loans and I will store the money inside of there so that when my premium does come due, I have the cash within my policies. I can go take it out if needed. But in January, because I have a policy due January 1st, and that one's actually my oldest policy, so I love to look at that one. But I have one coming due January 2nd. Did I say 1st? I meant January 2nd. I have one coming due January 2nd. And when I pay that premium, I have it processed. Okay, because there's kind of a time, right, for the bank to communicate with the insurance company. Yes, the check has cleared. But when that premium processes and I see it on my online portal that premium has been made, I will write into the insurance company and I'll say, hey, I just paid my premium. How much extra PUA premium can I fit into my policy this year? Because to go back to the mech, your mech is a moving target. And any time that you pay premiums into your policy, if it's a base premium or a paid up edition premium, anytime you pay that premium, your mech limits will move. And so I just get the information for myself for that year to see how much extra PUA premium I can dump in. And if I can, I'm going to go and do it. Okay. Good morning, Dave. Thank you, my friend. Hey, just real quick, Dave, I need to work on, you sent me that good gift. I haven't played with it yet just because I've been on the road, but I'm going to get that all done. And hopefully by next month, they'll be set up and you'll see in the background behind me. So I appreciate you. Lisa is saying, can you also explain PUA benefits in an upcoming episode? I'm also just learning about it too. Yeah, I got you, girl. Oh, let me do this, y'all. Let me send you my video resource. It's a very short video. And actually, I recorded this like in my early days getting into this whole world. So don't laugh at it. It's a little awkward. I probably need to re-record it at some point. But that's a YouTube video. Man, I wonder how old that thing is now. But I just posted in the comments a YouTube video where I get into base and paid up editions. So you can go and see that resource. Lisa's saying, hey, she just did that with more PUAs. Good job, good job. Okay, y'all. Real quick, Dexter's saying read chapter 6 over and over again. Are we talking about becoming your own banker? Is that what book? Or are we talking about building your warehouse of wealth? Here, let me move my computer screen up. Here's your resources. Becoming your own banker. Over here, I know you can't see it, but it's building your warehouse of wealth. There's also another one, Case for IBC. That one right there, Creature of Jekyll Island. Ooh, that one's so good. And then also shout out my companion book. So companionbook.com, so my children's book. Okay. Thank you, y'all. All right, I'm getting here up to my hour, so I will let y'all go. Have an amazing day. And like I said, if these are objections that have been on your mind, it's okay. Let's walk through the numbers and the design that fits you and schedule a call with me. You can message me. We can really build something that works for your stage of your life right now. So I'm going to put my email up here on the screen, hannah@themoneymultiplier.com. You can go and find me there. Next week is going to be Thanksgiving. So I plan on being here. Okay. So I'm going to be here 9 a.m. Eastern time. That's going to be 8 o'clock Central time when I'm in Texas. I'm going to be here because the topic I wanted to talk about today, it kind of involves my uncle, and maybe my uncle will join me for that episode. We'll see. So, okay, friends, thank you for being here. I will be back for another episode. And, if you need me, you know where to find me, okay? So sending my love, do well, be good today, and don't do anything I want to do, okay? I will catch y'all next week, okay? See y'all soon.